It's Finance Week here, and this week is all about stripping away all the finance jargon. I am Felix.
And I am Ruby.
Today, we're diving into the world of high finance to demystify a term you've probably heard a lot about: hedge funds.
That's right. It sounds complex and exclusive. So, what exactly is a hedge fund at its core?
Essentially, a hedge fund is a pooled investment fund. It gathers money from wealthy individuals and institutions and uses a wide range of strategies to chase returns.
So, it's not something the average person can invest in?
Exactly. Think of it like a members-only kitchen. In this kitchen, the chef is allowed to use special ingredients and advanced techniques that an ordinary restaurant simply can't.
That's a great analogy. It implies more freedom to experiment, but also higher stakes.
Precisely. And just like that exclusive kitchen, you need an invitation and deep pockets to even get a seat at the table. This exclusivity is a key feature.
And I assume that exclusivity comes with different rules.
It does. Compared to mainstream funds, hedge funds are very lightly regulated. They are generally restricted to large, qualified investors, which is why they operate in a different league from the investment options available to the general public.
So, with that level of freedom, what do their investment strategies actually look like? How do they chase those returns?
That's really the core of what makes them different. Their managers use incredibly flexible strategies. For example, they can bet on prices falling just as easily as they bet on them rising.
That's a significant departure from many standard investment funds that primarily profit when markets go up.
It is. They also frequently use borrowed money to amplify their bets and trade in complex financial instruments. The ultimate goal is to achieve returns in many different market conditions, not only during a bull market.
So they're designed to be adaptable. I imagine that kind of active management and flexibility comes at a premium for the investor.
You're right. Hedge funds are known for charging high fees. Conventionally, this includes a management fee, which is a percentage of the assets they manage, plus a share of the profits they generate.
That fee structure makes sense, given their goals. But that brings me to the name itself, hedge fund. It implies that they are primarily focused on hedging risk and are therefore safe investments.
That is one of the most common misconceptions. The name suggests safety, but the reality can be quite different. It's a myth that hedge funds always hedge or are inherently low risk.
So the name is a bit misleading then.
It can be. While the name does come from the strategy of hedging, many funds today take on large, risky bets to chase those high returns we talked about. Their strategies are not universally conservative.
That leads to another common assumption, that because of their sophisticated strategies and high fees, they must reliably beat the market.
That's the other side of the coin, and it's also not necessarily true. The performance of hedge funds varies widely. In fact, many do not consistently outperform simple, low-cost index funds over time.
So an investor is paying high fees for strategies that may not even deliver better returns than a basic market index?
Precisely. This is why hedge funds are a constant subject of debate. The central question is always whether their returns truly justify their high costs and the risks they take.
So, given that these funds are for a select group of investors, why should the average person be concerned with this debate?
That's the crucial takeaway. Even if you can't invest in them, hedge funds matter because they are influential players in the financial markets. Their actions can have a significant impact that ripples out into the broader economy.
And this influence is what fuels the ongoing discussion about their practices?
Precisely. Hedge funds are a constant subject of debate, focusing on those very points: their high fees, the level of risk they take on, and the ultimate question of whether their returns truly justify their cost.
So, understanding them is really about understanding a major force that can shape the markets we all depend on.
Exactly. Their role and the controversy surrounding them make them a critical and often debated part of the modern financial landscape.
That brings us to the end of the episode. If you think we helped you de-jargonize the term, make sure to subscribe and follow us wherever you get your podcasts.
See you on the next episode.